Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market live streams. Trying to come to you every Monday, 9 a.m. Eastern there. Get you ready for the week. We're doing it live this week. We had a recorded version last week. Just trying to get this thing out in front of as many people as possible. YouTube just kills the live streams after you're done recording, so you kind of flatline those, but we'll probably kind of trade off 1 week live stream, 1 week recorded on these. Love coming to you live, though, because we get to do that face-to-face Q&A section, so we'll have that today. See everybody out there in the Bowtie Nation. Love seeing you there in the chat. Melanie from Seattle, Dogo Dango wants to know how everybody's feeling about the market this week. Pretty shitty, probably, Dogo. It's market's down 5 weeks in a row. Looks like going to be heavy losses on the open today. And in fact, it has been 1842 since the bond market has been so bad. Bond market, long-term bonds down about 18% so far this year. That is the worst since Tyler was president, and only 26 states were part of the union back then. So a pretty big milestone for the bond market. Stocks not so much better. If the Nasdaq tech stocks in the Nasdaq down about 25% so far from their peak last year. S&P 500, so a little bit broader market index there, down 15%. And stocks aren't necessarily cheap yet either, though. The S&P 500 is now down to 17.7 times on a trailing or a forward earnings basis. So the price of the S&P 500, all the stocks in that index, divided by the expected earnings over the next year is 17.7 times. Okay, it's kind of like the trailing PE version that you usually hear about. That's just slightly above the 17.1 times average over the last 10 years. So, not nearly as expensive as they were last year, but not cheap either. Still about 3.5% above that long-term average. Quite a bit more expensive than the 20-year average. 20-year average PE ratio about 15.5 times on a price to earnings basis. So, that's not necessarily cheap. Doesn't mean stocks can't fall more, but we are seeing, there are some points of strength in the market that we want to talk about today. And one of them actually is just the level of negativity in the market. The American Association of Individual Investors puts out kind of a sentiment index, right? They survey all of their watchers there, and they found that negative sentiment among investors, the percentage of investors that think stocks will be down over the next 6 months, is at its highest since March of 2009. And if you've been investing for that long, it should ring a bell, because that was the very trough, the very bottom of that 2008-2009 crash. Right, stocks bottomed in March 9th, 2009. Continued higher from there, and we are now at that level of bearishness, that level of negativity, and a lot of times that index is taken kind of as a contrarian index, right? When everybody is so negative, everybody is so pessimistic, then there's really no more buyers, or there's few sellers. Everybody is a seller. And so, any kind of good news can really take the market higher. So we are looking for kind of a relief rally on that. But there's also some other things we need to talk about this week. Again, love seeing everybody there in the chat there. Danny, Rich Dad, got the Twilight Zone in on Friday, so that was always that's always a good start to the week, or a good end to the week, watching my Twilight Zone and having my Jack Daniels Friday night, waiting for the market to open on Monday. Got a busy week for you this week, though. Big video going to show you where the analysts are seeing the biggest returns in the market for over the next year. The stock sectors and the stocks within those sectors. Actually, one sector, Wall Street analysts have an average forecast 40% higher from where it is right now, and 3 sectors above 30% over the next year. So we're going to look at those stock sectors. We're going to look at some of the stocks in those. Stick around after that. I want to give you that right away, though, because everybody says I talk too much, and I know a lot of you are here to see those stocks specifically. So I'm going to get right to those, but stick around, because we're going to be talking about everything to watch during this week. One piece of economic data coming out on Wednesday that could be the only thing that matters this week. The big news this week that is going to actually guide market sentiment and the market for the next few weeks, at least, maybe for the next few months. So stick around for that. Stay tuned for that. I want to get started though, but I do want to invite everyone to get this free report I put together with Motley Fool. A lot of you will recognize this if you've been in the Bowtie Nation for long. It's just a free report I did with the Motley Fool. It's the largest stocks in my own portfolio, some of those long-term, very long-term growth stocks that I'm investing in. I'm going to put a link there in the chat, or I'll put one in the video description as well. Click through. It's completely free. You enter your email address, you get that free report. You see those stocks that I'm investing in. Yeah, Motley Fool is going to send you some emails trying to get you to sign up for their portfolio advisor or stock advisor program. I've used the service in the past. I like some of their advice. Some of it's not so great, but I do like it on the margin. But it's totally no obligation, right? It's free. It supports the channel, so please you click through that and sign up for that, and I'll be able to feed my kids for at least one more week. But let's get started here on this because I know you're anxious to see those stocks that Wall Street analysts think are going to be up 30 and 40% over the next year. We're going to go here to Factset Earnings Insight. This is a great resource, folks. A lot of you have seen me use this before, and it's absolutely free. You just go to Google, you type in Factset, right? You can type in Factset, you can type in Factset Earnings Insight into Google. It's probably going to be the first one that comes up. It's going to be a PDF copy. Each week they update this on really where the market is at in terms of earnings for companies in the S&P 500. All of you know earnings are what guides stocks over the long run, right? Stock is a ownership share in those earnings of that a company is generating, and that's going to that's ultimately going to be what guides stock prices. So we're gonna go in here, and an interesting chart they usually have at the very bottom here, if you scroll all the way down, is, and I want to make sure this is showing right in the screen here. Okay, now this is the S&P 500 sector level bottom up target price versus closing price. So what this is the Factset surveys Wall Street analysts, right? Analysts working on buy side firms in Wall Street. Their target prices for all the companies in the S&P 500, their target prices for each of those stocks versus the closing price of where those stocks are right now. So obviously that's going to give you, how much upside they see in, all those stocks for each sector of the economy, over the next year. Now, a couple of things to understand here. One is that as you're looking at these, okay, they see communication services all the way over here to the left, 39.2% return over the next year. So the target price of all the stocks in the communication services sector in the S&P 500, they expect them to be 39% higher on average over the next year. Followed by consumer discretionary, 36.1%. Technology stocks expected to be up 31% over the next year. The overall market, 25% over the next year. So analysts on average expect the S&P 500 to be up 25% over the next year. Now, again, a couple of things to understand here. One is analysts aren't infallible. In fact, I know a lot of them that couldn't predict the weather if they were standing outside. Okay, if any of you that follows analyst expectations, analyst estimates, or analyst target prices on stocks, a lot of times they'll follow the stock all the way up on their target price, and then kind of lag it coming down, lowering their target price all the way. So analysts aren't infallible. They do have the experience, though. They do have the training, the experience, and just the tools to make good target prices. So generally, they are pretty good at. I guess I'm a little bit biased. Being a former analyst myself, they are pretty good at setting target prices and analyzing stocks. Okay. Now that said, a lot of these maybe these target prices for these stocks in these sectors, they haven't been adjusted downward. We've seen some big moves over the past few weeks, over the past few months on earnings. A lot of these stocks coming down, and I have a feeling that a lot of the target prices for these stocks are going to be adjusted downwards on those earnings and on those forward expectations. We're going to talk about some of those expectations and what is really driving stocks down in a minute here. But I want to look at some of these. So you've got communication services, which that sector is, and we're going to look at some of the stocks in these sectors, kind of give you a feel for what to look for. But these are the communication services sector. That's going to be your telecom stocks, as well as your internet stocks and your social media stocks, right? So obviously here, the big upside potential is probably in those internet stocks, the social media stocks that have been hit so hard over the past few months, really since November. and have fallen so far. Consumer discretionary. Now, this is an interesting one. So the communication services sector, we'll look at that. In fact, let's jump back and forth here. So if you ever want to look at and see what stocks are in a sector, if you really like a sector, and folks, this is all you out there in the nation know, this is my favorite way to invest, is looking at that big picture. Getting a big picture idea. Okay, what are the forces? What are those big picture forces in the market right now? Whether it be consumer spending, whether it be some other forces, and really narrowing it down from there, because it is so much easier to say, okay, you know what? There's a huge amount of a huge growth in credit card spending right now, spending for services, services for travel and leisure that people were really locked out of over the last couple of weeks. And so you can take that big picture idea and narrow it down into the stocks to buy, rather than just trying to pick, one or two stocks out of the 5,000 listed on the U.S. exchanges. So you want to start with these big picture ideas. But then, so if you're looking at communication services, you go here to sectorspider.com. Okay, sectorspider.com gives you this sector tracker that we use quite a bit on the channel here. And you can click through any of these sectors. It's going to show you what they did over, the last 5 days, the year to date, the last month. And you can click through here and see what stocks are in those sectors. Okay, so here within the communication services sector, down 24% so far this year, down quite a bit more, just since November, since the November peak. And you can look over here to the left or to the right. These are all the stocks in that sector within the S&P 500. So the largest 500 companies in the United States within the communication services sector, that sector that analysts believe is going to be 40% higher over the next year. And you can kind of get a feel for which stocks are lagging, which ones are leading, and which ones might have opportunities in them. We're going to go here to the biggest losers of the group, because I have a feeling that's where the target prices by analysts are probably the highest. So you've got Netflix leading the group downward with a 70% loss over the last year. Now, I'm a Disney Plus guy just because I'm a fiend for all things Marvel. So I don't have a subscription to Netflix. A lot of people canceled their Netflix subscription over the last quarter. That might change. I think negativity is probably reaching a peak here in Netflix. It has been a strong stock. We'd have to look at the valuations on that for anything there, but Netflix, if you're bottom fishing there, Netflix is at the very bottom of that sector. Match Group, interesting. I actually saw an analyst upgrade today on Match Group. So analysts getting a little bit more positive on Match Group. It's down 44% so far this year. Meta Platforms, which again, I will never call it Meta. It will always be Facebook. Ticker FB there, down 40%. And for all the reasons to hate Facebook itself and the platform, the shares are down 40% so far this year. It is still a commanding lead, a commanding competitive advantage in social media. No other platform, no other social media platform really has that kind of scope and that ecosystem that Facebook has. Facebook has the main platform itself. It has Instagram, it has WhatsApp, it has Messenger. No other social platform really has that depth of different platforms on it. You've got Twitter, you've got Pinterest, all those other ones are pretty much standalone sites that can't really leverage those multiple platforms that I think Facebook can. So I actually do like Facebook at this point, down 40% so far this year. That's definitely one to look at, and I know that's one that analysts have quite a bit higher target on, right now. So that's probably a big contributor to the 40% upside on the communication services sector that analysts have. Walt Disney, we're going to be talking about that later on in the live stream. One of the 7 stocks I'm watching this week. It's going to be reporting earnings on Wednesday, down 29% so far this year. So obviously Walt Disney got hit pretty hard when Netflix reported its own subscriber losses on its streaming service. But obviously Walt Disney has a lot of other things going for it, and I think some upside potential from here and even on Wednesday on that earnings report. So that's how to find the stocks in the communication services sector. Other stocks here, if you're looking at, so we've got consumer discretionary, and I do like the consumer discretionary sector. The consumer is still strong. People are spending like it's 2019, right? People are finally getting out. They're going back. They're going back on their vacations. They're going out to theaters. Cinemark, ticker CNK, Cinemark Theaters reported last week. I think we get AMC Entertainment reporting this week. I think on Wednesday. We'll cover that here in a little bit. But Cinemark reported very good numbers last week. A lot of people going back to theaters. Not a lot of great movies coming out, but it seems people are just anxious to get back out into the theaters and in a lot of these other stocks. So consumer spending is still very strong. We had J.P. Morgan banking numbers out a few weeks ago, all showing that consumers are very strong. Credit card spending doing very well. Credit card spending, I think, was up something like 19%. I want to say 16, 19% over the first quarter, with credit card spending towards hotel and travel and leisure related companies up like 69%. It was an amazing jump there on a year-over-year basis, which is why we've been very positive on a lot of those stocks over the last few weeks. And those have held up really well during the earnings reports. So this 36% upside on the consumer discretionary sector. Now, obviously, there are stocks in that sector that are going to continue to get hit. We can go here and look at consumer discretionary. So here, obviously, consumer discretionary is going to be all those things that you don't really need to buy, but you just got to buy them anyway. So pretty much everything except lottery tickets in here. You've got auto parts. You've got fast food with McDonald's. You've got Dollar General, so the dollar stores, Marriott hotels, Newell Brands, Royal Caribbean, those cruise lines, Best Buy, Hasbro, toys, that kind of thing. And what's interesting here is a couple of these names really stick out as stocks that I've seen doing the research over the last couple of weeks on stocks that did well over the last stock market crash. Right? If you didn't see that stock. The video I think we did on Wednesday of last week, 7 safe stocks to invest in, 7 stocks to watch. It was really looked at the research that I did along with Stock Card as far as which stocks did well over that 2007 2008 crash, and we really saw strength in the auto parts stocks, right? So here you see firsthand the best performing stocks in the consumer discretionary sector over the year to date. You've got AutoZone in there. You've got Genuine Parts in there. So you've got those auto parts stores that are while they're still negative for the year, they're holding up very well against that against the consumer discretionary sector and the larger index, the larger market itself. You've also got the dollar stores. Obviously, when people cut back, they don't cut back on the dollar stuff because their money goes farther at Dollar Tree and Dollar General. So those stocks holding up pretty well. McDonald's always holds up pretty well in a recession. And then you've got some of the travel and leisure stocks that like Hilton, like Booking Holdings, like Marriott, that have been doing well on that theme that we've been talking about. People are spending on travel and leisure. People are getting back out and they're anxious to spend on those things. So those are all holding up really well during their earnings reports. So I do like consumer discretionary sector. Technology, analysts still have 31% higher expectations for that sector over the next year. Market as a whole. Now I want to look at some of these others. Okay, financials. Analysts are usually much more negative, much more pessimistic on the financial sector. They actually see it 23% higher over the next year. And obviously, the financials have been hit lately. On fear of an economic slowdown, fear of those loan losses increasing at the banks. So the financials are down 11% so far this year. But this is one of my favorite sectors, I got to tell you. And even though, even if we do get a recession, which I do believe we will get a recession in 2023, even if a recession hits, obviously it's going to hit loan demand. It's going to increase loan defaults. But even given all that, these are still some very good value stocks in the financials. You're going to get some great dividends there on some of those stocks, and they're doing what they need to do to get through the next recession and really make you money on the other side. So in the financial sector, obviously, you're going to have a lot of insurance companies, market companies, so trading and brokerage companies. You're going to have a lot of mostly banks. So here, if we look at the laggards for the financial services sector, I would stick with the banks if you're looking for value plays here. So you've got things like Signature Bank, SVB Financial. SVB Financial is one we've highlighted on the channel before, down 27% so far this year. This is a bank. It's based out of San Francisco, so it's got a lot of loans and equity relationships with a lot of the tech names, the tech companies that have been hit so hard, the tech startups that have been hit so hard over this last year and over this last few months. So that's why that one's down, but it is still a good bank. You're also going to have some of the larger banks that I would look at. JP Morgan down 22% so far this year. Goldman Sachs down 18%. And actually, Goldman Sachs is trading at a level that I've never seen it before on a price to earnings basis. A lot of these bank stocks are. So, if you're looking for good value plays, if you're looking for good dividends, the financials are definitely the place to be. I think I've started increasing my exposure to some of the banks that we've talked about here on the channel. On the other end of the side here, we can look at the stocks or the sectors that analysts don't believe have a whole lot of upside over the next year. All the way over to the far right, we've got utilities up 11% over the next year, consumer staples up 10% over the next year. And really, these are slower growth sectors anyway. The stocks in those sectors don't tend to take off because they are those safety, slow growth companies. They've done fairly well over this last few months as the stock market crashed. Obviously, safety sectors, these are selling things that you have to buy, like electricity, like food, like Pop-Tarts. So those aren't going to fall too bad in a recession. So you've got utilities and consumer staples. We can see here utilities are actually one of the few sectors, one of the only two sectors that is up so far this year, up just under 1%. The consumer staples sector down just 0.5%. So both of these protecting your money during the recession or during the stock market sell-off, like they should and like they have traditionally. So that's just something to look at. Obviously, again, analysts aren't infallible. I do not believe that the communication services sector is going to be up 39-40% over the next year, but I do believe there are some good deals in that sector and in some of these other stocks that they're talking about. So I want to open it up, and we're going to look at what to watch this week, what I'm watching. Again, what could be the most important news this week for the stock market coming out on Wednesday. I want to go back to the sector spider and really look at the sector trends over the last week, see what we can get from that. And for all the pain that was in the market over the past week, it was actually, the five of the 11 stock sectors actually managed to close higher. Obviously energy was kind of the standout leader there, 10% higher on those higher oil prices. The European Union did propose a ban to ban all Russian oil and gas starting this month, starting in May. And kind of a slow ban on that. The thing is with this, and why oil didn't just boom on that news, it did go up higher to about $110 a barrel. But if you did get a ban on Russian oil, it would be up, $120, $130 a barrel. The reason why it did not do that is because in the EU, you have to have a unanimous decision to pass any of these kinds of bans or laws or whatnot. And Hungary's Viktor Orban, President Orban, longtime Putin ally, is going to stand in the way here and probably hold that ban up. So, it's probably more talk than it is something that is actually going to happen, but it is supporting oil prices here. While the consumer prices staples sector did fail to provide that support last week, so we saw consumer staples down a little over 1% last week. While it did underperform the market last week, there are some pretty good stocks here in the group, stocks that I would definitely be watching. So we click through here, consumer staples. Last week, we had Clorox up 7%, Kellogg Company up 6%, Campbell Soup up 5%. So, even though the overall sector was down 1% last week, there are some deals there to be had. And I think, something we've been talking about over the last couple of months or over the last month is that these consumer staple stocks, those food packaging, the food companies, got hit early on that inflation scare, right? On the inflation, the companies were the first to really experience those higher prices on their own materials, on those agricultural inputs that go into that food and that kind of thing. And they weren't able to pass those costs on to consumers, okay? Consumers really hadn't felt that inflation pressure yet. So companies didn't want to try to pass on those costs. So what we saw last year was the consumer staples sector fell hard. A lot of the stocks in this sector fell hard because their profit margins were down quite a bit. What we're seeing now is that consumers are used to the inflation. Consumers know prices are going up. They're ready to spend anyway. Consumers are still fairly strong. So what we're seeing is these companies are now able to pass those costs on to consumers. So their profit margins are increasing. Their revenues are increasing much faster than they usually do. You look at the revenue growth on a lot of these consumer staples companies, generally it's in the 2 to 3% range, right? It's very low. Obviously, you buy all the Pop-Tarts you need each week. You're not going to buy any more over the next year. You're just going to buy pretty much the same amount. So revenue growth is usually about 2% to 3% a year. A lot of these companies now booking revenue growth of 3 to 5 to 7% a year because of those higher prices that they're now able to pass on to consumers. So a lot of these companies doing very well right now. I would watch these, especially for the safety that if you're worried about a stock market crash and prices getting even worse than they are right now, look to these consumer staples stocks, because those are going to provide the downside protection as well as maybe even some upside potential for that. Also here, the financials, started to regain some of their losses over the past few weeks as interest rates really jumped higher. We've been talking about this. Obviously, banks make their money on higher interest rates. So with the 10-year Treasury up as high as it's been since 2018, the Treasury ended last week up to over 3%, hasn't been there since 2018. So financials, bank stocks should be doing well. Bank stocks should be making more money, except for fears of a recession, right? Fears of higher loan defaults, fears of lower credit demand, things like that. They were up last week though, and they started to claw back some of the losses over the last few weeks. Again, I think this is a value sector. Look at some of the banks there; they're putting money aside in those higher loan default provisions, and I think higher interest rates are going to come through and mean higher profitability for them. You look at some of these other sectors. We've got communication services up slightly last week, so it was interesting that the market was down so far. It was down negative last week for the 5th week in a row, but we did have some considerable strength across the rest of the market. Now I want to look at kind of what to watch this week, and then we'll look at some of the stocks that I think are going to highlight this week. Some of the stocks are already moving here, as the market opens. And it does look like the market is going to open negative today. It's going to be a rough day for investors. S&P 500 or Nasdaq futures down 2%, S&P down almost 1.5% as we move into the market open. Going to start talking about some of these stocks for the week. Really, the big news this week, and the only thing that's going to matter this week, is the Consumer Price Index. Okay, we get the Consumer Price Index, the monthly report of consumer inflation, out on Wednesday, and it's going to be a big one, right? This is the one where all the expectations are that inflation did peak last month in March. Well, for the March numbers reported in April. So we get April numbers reported in May here on Wednesday. The expectation is for that year-over-year increase in consumer inflation to be down to 8.2%. Now that's compared to 8.5% last month. So not a huge loss, but anything lower on inflation would be huge news. It is largely expected. So what I believe is going to happen is if we do get pretty much at market expectations on that, we could see some kind of a very light relief rally. Stocks probably won't take off, but investors will be kind of breathing a sigh of relief that inflation is starting to come down. That's going to give us at least 1 month to the next CPI report to kind of say, okay, you know what? If inflation is starting to come down as we expected, then the Fed won't have to raise interest rates quite as aggressively as maybe we thought. If it comes down way under expectations, if it comes down to like 8% inflation or even less than 8, investors are going to be singing in the streets, right? It's going to be, a holy day, angels singing and all that, and the market will take off. Now, if it's higher, though, it's going to be a completely different tune, because if inflation comes out, higher than 8.2% expected, if it comes out 8.5% or higher than last month, then that's going to mean the Fed is going to have to remain aggressive on its interest rate hikes and probably lock in a 75 basis point hike in the next meeting. So 0.75%. 75 basis point hike. It's really going to mean, especially with last week's good employment numbers. Okay, last week's jobs report came out stronger than expected, as I thought it would be, and that's really saying that the Fed can be as aggressive as it needs to fight inflation, to bring inflation down. So if we get continued high inflation on Wednesday through that consumer price index, then the Fed's going to have to raise rates even higher, and it's going to really hurt the market. So I'd be watching for that and be hedging for that. Market's basically wrapping up earnings season. We've got 87% of the stocks in the S&P 500 already reporting earnings last week and reporting very well, reporting good earnings. About 79% of those are beating their earnings expectations. The problem here, and this is what we're going to talk about in these stocks to watch this week, the stocks that are reporting their earnings this week, like Palantir, that is down like 15% pre-market and as the market opens, is they are, a lot of these companies are managing expectations lower for the rest of the year. So let's go ahead and look at those stocks that are reporting this week, stocks to watch this week. I'm going to increase this a little bit so you can see it. Palantir opening down almost 20%. Brutal opening for Palantir. And we can actually expand this to the max. It is now down well past the issue price, right? So Palantir came to market with an IPO in 2020, right around $9 a share. Immediately jumped on the on the market bullishness, but is now down to $7.60 a share. Well down. And what happened is what we're seeing with a lot of these stay-at-home stocks, the new tech stocks, fintech stocks. A lot of these stocks, they are still reporting growth. Palantir, I believe, beat on its revenue and earnings expectations. It beat those expectations. The problem is, like so many of these stocks, they guided lower on their 2022 estimates for revenue and for earnings. Okay, management came out. They said, hey, look, we're looking at higher interest rates. We're looking at the Ukraine invasion. We're looking at what's going on in the stock market, what's going on with the broader economy. And we're getting a little worried that, maybe we were a little more too optimistic about what our revenue would be for the rest of the year. So we're going to guide that lower, and we're going to tell a different story here. And really, that's what's spooking the market. The investors had bought into these stocks on a price to sales multiple that was based on the sales expectations over this year, over the next year. And now the company is saying, okay, those sales expectations are going to have to come down a little bit. So that is destroying these stocks. And honestly, I got to say, it's making a lot of these stocks, these growth stocks that we've looked at, the stocks that were so popular over the last couple of years during the pandemic, it's really making them kind of uninvestable right now. I got to tell you, the problem is not that these aren't great companies, not that these aren't companies that you can still hold long term. And I still own a lot of these stocks over the long term. The problem is that sentiment, that investor sentiment works both ways. Okay, whereas last year, the year before, over the last couple of years, anytime stocks dipped a little bit, you could count on that investor sentiment, that positive sentiment in the market, to buy the dip and push these shares back higher. Well, now that sentiment is so negative, as we saw earlier, the American Association of Individual Investors negative sentiment index is down the lowest since it's been 2009. Investors just believe stocks are going to be lower over the next 6 months. So they're taking any opportunity to sell the upside, right? Whereas it used to be buy the dip, now it's sell the upside. So anytime stocks go up, investors are selling, taking profits and getting out, right? So you've got that negative sentiment hitting, and you've got the 1-2 double whammy on these, where not only do you have negative sentiment, but you have all these growth stocks that are now repositioning growth lower, that are now saying, okay, you know what, we're going to be a little bit more conservative in our estimates just so we know we can beat those over the next few quarters. And again, folks, this is something we've talked about in the on the channel before. A lot of this is just a game, right? This is management has to beat those expectations. Their paychecks, their $1 million paychecks depend on beating those expectations. So each quarter, the market analysts have an expectation for how much the company is going to report on revenue, on earnings. The company has already come out, in prior quarters and say we're estimating that we're going to make this much in sales and this much in earnings for each of these quarters. When the company comes out with those actual quarters, they have to beat those, all right? Because how do you justify a $10 million paycheck each year if you can't, you can't beat expectations? So we typically see this in the first quarter, over these first few months of the year, where companies come out, management comes out and says, you know what, we're going to be a little bit more conservative. We're going to downgrade our expectations for the year. So when those quarters do come around, they can beat those. So, I am expecting when these quarters, the second, third, and fourth quarter, are reported later on in the year, companies are going to beat those expectations. They're going to report better earnings, better revenue than they expected. And, it's going to support the stock a little bit better than what we're seeing right now with these massive sell-offs in these stocks. So I want to get back to the stocks I'm watching. I did see we had a super chat there, Intermediate Handyman. I appreciate that. I'm going to get to your question real quick here, but I want to cover the rest of these stocks reporting. So Palantir reported earnings today. Again, actually, I wish I could have gotten my newsletter out last Friday. The newsletter, Bowtie Nation, comes out every Sunday before the market open. In that newsletter last night, I actually did warn that this was going to happen. The stock is still trading at over 10 times this year's expected sales. So right at that high point that I even consider, for a growth stock. So still very expensive stock, down 20% today. So now it's down under that 10 times, and maybe something to look at. But I was worried about the potential to reduce that outlook, and that's exactly what we saw today. Tyson Foods also reported today. Reported shares pretty much just slightly positive. Today they did report good numbers. And it's really joining, like we said, joining a lot of these others in the consumer staples sector in that traditional role of safety in the crash, right? Not only are these companies like Tyson Foods selling the stuff that we need, we all need those ribs, right? We all need the pork ribs. They are selling the things we need. But again, like I said, they got hit last year on the initial inflation, and now they're finding they're able to pass that on to customers. They're expecting 10% sales growth this year. Okay, so Tyson Foods, they sell chicken, they sell pork, and I gotta tell you, I don't know about you, but I'm not buying any more chicken or pork than I did last year, which is to say quite a bit. But I'm not increasing my chicken and pork intake 10%. Over the last year. And that means what that tells me is they're increasing prices. They're able to pass those prices on to the consumer. I'm paying it because I want my chicken and pork. So they're expecting sales 10% higher this year. And that's what we're seeing in a lot of these consumer staples companies. They're raising prices. Consumers are eating it because they need to eat it, right? They need their Pop-Tarts. They need their pork ribs. So they're going to pay those higher prices no matter what. So these consumer staples companies, Tyson Foods comes through with a good 2% dividend yield and a relative safety play. So definitely be watching those, as we get into the rest of the year. BioNTech, ticker BNTX, also reported earnings today. They actually impressed on the upside. They did very well as far as the COVID vaccine. I would kind of wonder here because shares aren't necessarily expensive as it was last year. It does have a strong balance sheet, but I'd still wonder what they're going to do, what BioNTech is going to do after COVID, right? They still need to be able to tell investors what the next big blockbuster drug is. So up 5.8% today. I would actually prefer some of these other drug makers. We have seen the drug makers did very well over the past crash. One of the sectors that held up very well in the 2007-2008 crash. So be looking at drug makers. I like Gilead Sciences. I like Pfizer. I like a lot of those. AbbVie is also a very good one. Very good, strong dividend yields and safety in any kind of a stock market crash. AMC is also reporting earnings down slightly. I believe they report earnings after the opening bell, though. So earnings aren't out yet. We'll see tomorrow how the stock does on that. They're going to need to say something more than just sales are up to save this stock, folks. Sales. The company is still trading for about 1.7 times its full year expected sales, which is higher than other theater stocks like Cinemark. It is. Sales for the quarter are expected up 384% to $743 million. Okay, AMC expected to hit $743 million in sales over the first quarter. That's up almost 400% over the last year. So investors already know that, though. They already expect that. They already know that it was a good quarter for these theaters. They're going to have to say something stronger than that, though. They're going to have to say something about the $11 billion in debt weighing on this company and how to get that back up. And with the meme stock investors kind of leaving the market over the past couple of months, they're going to have to do it without them. So I'd be cautious on AMC, just on especially on that debt. $11 billion in debt. This is only a $7 billion market cap, folks. So it's got more debt than the market value of the shares. So one to watch there. Reports, I believe, after the bell, after the close of the market today. Coinbase down 7.6% today. Reports earnings Tuesday. It's going to have a heavy lift to appease investors. Okay, it's down 7.5% today, now down 68% from its April listing last year. Okay, analysts are expecting it to report a drop in sales of 18% to about 1.5 billion compared to same quarter last year. And again, this is supposed to be a growth stock. This is supposed to be a stock, those growth stocks growing sales at 20 and 30% a year. This one is losing 18% over the last year in its sales. And obviously, a lot of that is just in the a lot of the wind has come out of the sales for cryptocurrency, Bitcoin, and a lot of those prices are down. And we've talked about Coinbase before. I do believe in that long-term thesis, that long-term reasoning and theme for cryptocurrency. But the problem is, it doesn't necessarily mean Coinbase is going to do well. It doesn't necessarily mean a lot of these platforms are going to survive. You could have Bitcoin do very well, but if Coinbase can't compete against some of these other platforms, Robinhood, Bitfinance, or Binance, right? A lot of these other platforms, then it's not going to do well. They did try to move into NFTs over the past month, but that might be just a little too late. A lot of I think the bubble is popping on the NFTs as well. And so it probably didn't help Coinbase very much. Not going to be a lot positive they're going to be able to say about that over the next, for this next year. So Coinbase down almost 8% in the market today. Obviously, investors worried about that earnings report coming tomorrow. Occidental Petroleum, ticker OXI. Now this one is actually down 4.6% today. Obviously, a big part of that is crude oil. Crude oil is down 2.25% today. Really, a lot of that give back from last week's major move in crude oil, up above $110 a barrel. So giving back some of those gains from the last week. Still up very strong, though. This stock is up, skyrocketed 109% since the beginning of the year. Shares of Oxy Petroleum up 109% over just the first 4 months of the year, along with a lot of the stocks in the energy space. And of course, a lot of this is also attributed to Warren Buffett, who's now amassed a 15% stake in the company. Warren Buffett, in his Berkshire Hathaway portfolio, owns 15%. Earnings are obviously going to be good, as they have been for all of these energy companies. These are just cash flow machines right now, but I do believe there are better plays in energy stocks than Oxy. Okay, Oxy is now trading for 3.8 times on an enterprise value to sales basis. So the value of the company, with its cash and debt minus or divided by its sales expected sales. 3.8 times versus about 3.5 times for Devon and 2 times for Chevron. Okay. Now, we've liked Devon Energy, ticker DVN, in the past. It's getting a little bit pricey itself, but it does produce a 7.6% dividend yield. Okay, so you compare the dividend yield of just 0.8% on Occidental against a 7.6% yield on Devon Energy, both valued right around the same price. So both kind of expensive on a price to sales and enterprise value to sales basis. But that that dividend yield on Devon Energy is just one it's hard to pass up, especially compared to Occidental. Chevron, we've liked Chevron, ticker CVX, in the past here. It's actually down to just 2 times valuation and a 3.3% yield. So, if you do believe oil prices are going to stay high, I do believe they are going to stay high for a while. There is no end in sight on this Ukraine invasion, on the Ukraine conflict. And even without that, oil prices are going to be well above the cost of production for these companies. So they're still going to be cash flow machines. And something that you want to watch for to protect your money, against some of these other stocks. Last one here, and we'll get to Q&A. Walt Disney Company, ticker DIS, reports earnings on Wednesday. This is going to be a big one. Obviously, investors nervously watching after Netflix reported that horrible quarter of its own. Disney, like we saw there in the sector watch, is down 30% so far this year and 41% from the peak of last year. But there are a couple of points that really make me more optimistic on Disney. Okay, first is, I think the Disney lineup on Disney Plus was much stronger in the first quarter. And again, I'm biased because, I am a fiend for all things Marvel. So I was watching those. Actually, just started watching the Moon Knight series. Looking forward to the Obi-Wan series coming up. So I'm a Marvel and Star Wars fan, so I'm going to be a little bit biased here. Understand that, but I do think the Disney Plus lineup was stronger in the first quarter. So maybe helping them retain some subscribers where Netflix failed, where Netflix actually lost subscribers. Disney also has the theme park revenue, right? Which, obviously it might not have boomed higher over the first quarter, but they're going to be able to talk about it here in the earnings report. And again, remember, that is just so important right now. What management is saying about the rest of the year, really more important than what they're saying about the last quarter. What they actually made is what they're saying, okay, where are sales and where are earnings expected for the rest of the year? And I think they're going to be very optimistic, very positive on that theme park revenue. And it's really going to support the shares. So analysts are expecting sales growth of 34% this year to about 80 billion, which is strong growth. So, has me a little worried that management might try to guide those expectations down a little bit. They could still be very positive on Disney Plus, on theme parks, but they might still want to guide that down a little bit. But that said, shares are trading for 2.6 times on that price to expected sales basis, which is well below the 3.5 times average over the last 5 years. Okay, shares of Disney have traded on average for 3.5 times on a price to sales basis over the last year, now down to 2.6 times after that 41% sell-off. So I think this is a good value, even if we do get some kind of short-term pain on Wednesday, even if they do come out negative on those earnings expectations over the next year, the stock suffers a little bit. I don't think it's going to fall that much because it's already down 41% and it's already well into value territory. But I think this is a good value, even if you have to take a little bit of short-term pain. So I would be watching that on Wednesday. Let's turn this over to the Q&A. Again, one of my favorite parts of these live streams, just because I love that face-to-face back and forth we get here. Intermediate Handyman, again, thank you for that super chat. I appreciate that. Portfolio is all red, some 10%, 20% down, trying to hold and DCA at good times, but it's tough. Okay, yeah, it is tough, but I got to tell you, and this is going to be kind of contrary to what you might be feeling right now, but this is the best time to invest. Okay, keep investing. A lot of people, again, I'm amazed that people love to buy everything they can, as stock prices are going up, but then they get disillusioned. They get frustrated when stock prices are coming down and they just completely leave the market. They'll sell, they sell stuff, they leave the market. And then what happens is eventually when the stock market does rebound, they're still scared to get back in, right? They're not sure that if it's a true rebound or a true bull market. So they wait a year or two to get back in, and they miss out on a lot of that upside. The only way to beat that is just to stay invested, okay? That doesn't necessarily mean you need to put all your cash into the market right now. I would hold some cash aside. We've talked about I-bonds over the past couple of weeks, an excellent way to protect at least $10,000 of your cash in I-bonds over the next year. You get 9.6% interest on that. And it's a guaranteed safe return. Okay, so there are ways to protect yourself. but stay invested. Okay. One of the best examples of this is Amazon, and you've heard me talk about this before in the past. Amazon closed at $5.60 a share in 2002. It was down like 95% from its 2000 peak. Okay, and it had just gone public in 96. I think this is a very good example for investors right now. Investors investing, new investors over the last couple of years that bought in at those highs. Amazon was down 95% to just under $6 a share in 2002. Now, where's it at today? Something like $2,500. Okay, so imagine holding a stock today for $5-6 a share that in the next 20 years is up to 2,500. That's like 65,000%. Okay, that one stock can make you a millionaire with just $2,000 invested. So what you need to do, what you really want to do with these stocks, and that doesn't mean don't sell. It doesn't mean don't sell some of the stocks that you really don't believe are good investments, good long-term investments. But you really need to look at your portfolio and find those stocks that you really believe have that long-term potential, that long-term future, that Amazon potential, right? The potential to change their industry, to really change how we live our lives in that industry and in that product type. Okay. Some of the things I'm looking at, a lot of you out there in the nation, what I'm looking at. I'm looking at Teladoc Health, okay, a commanding lead in the virtual healthcare space, okay, and obviously, people getting out of their house, they're getting back to the doctor, all that, and so sales aren't quite as good as expected in Teladoc, and the shares are way down for it, but you can't deny that virtual health, virtual anything really, is the future, is the way, the trend and the direction things are going. This company has a commanding lead in that space against all other competitors. So I really believe, it's an example of a company that is going to dominate and change that industry over the next 10 years. It might take 3, 5, even 10 years to really prove that thesis, prove that theme, but if you could go back to 2002, when everybody was crying bloody murder and the sky is falling and selling Amazon down to $6 a share, and you really believed that about Amazon, that it was going to change e-commerce, wouldn't you invest? Wouldn't you buy those shares for $5-6 a share? So you really have to look in your portfolio, find those stocks that you really do believe are going to change the world, and stay invested in those. Again, over the next couple of years, especially if stocks continue to fall, you continue to put your money in those stocks, in those long-term stocks, and those long-term growth stocks, and you just hold on, because they will prove you right. You do that analysis, and they will prove you right. Okay, I mean, a lot of this just comes with experience, folks. I started investing in 1999, and I think that is the perfect example for a lot of investors, a lot of new investors right now. I started investing in 1999, which has got to be probably the second worst time to start investing ever. Okay, the worst time was probably, over the last year, in February of last year, probably the worst time to start investing. But 1999 is a close second, because we all know what happened, a year after that with a lot of those tech stocks, with a lot of those internet stocks and e-commerce stocks. They just fell off the cliff, like the growth stocks have done over the last year. But I stayed invested. I stayed invested in a lot of those stocks. I continued to invest, and I've done really well. I invested through that 2000 internet bust. I invested through the 2008 financial crisis. So I've lived through quite a few of these stock market crashes, many corrections. And I just got to tell you, you got to stay consistent. Stop looking at your portfolio of your stock. Stop looking at your stocks as something that's going to make you rich next year. Okay, it's just not how it works. Okay, we have just lived through a historic time in stocks, with the Fed boosting the economy by $5 trillion, pushing $5 trillion into the market. The federal government pushed another few $1 trillion into the economy to support the economy. And that money had to go somewhere. It went into stocks, and it pushed those stocks into crazy high valuations. And now we're seeing the other side of that. We're seeing stocks come down. But again, if you look at stocks, any stock chart you look at, over the last 20, 30, 40 years, 50 years, 70 years, any stock chart you look at, the one guarantee that you have is eventually stocks will continue to go up. We will live through this, and you will make money. What else? What else? I'm gonna scroll down here and see what else we have as far as questions. If I don't see your question, please ask it again in the chat, and I'll try to answer as many of these as possible. Again, great to see everyone here. Danny, Rich, Kenny Scott, Ambrose, good to see you always here. Longtime member of the Bowtie Nation. I know I saw Chad Taylor there of the Lifters Gym there in Albemarle. Good to see you there, brother. Gilberto Semper Fi, Ura, brother. So we're going to scroll through here and see what we can find. Good morning. Thanks, Joe Fang. Still holding. Yep. Okay. So Kat says she's still holding Fang, holding since $25 a share. Fang. I mean those Diamondback Energy stock shares. We've been in those for last couple of years. And yeah, she's in from $25 a share. It's $138 a share right now. A crazy upside on the energy stocks over the last couple of years. 2% dividend yield still. So, I still think these are good dividend stocks, good cash flow stocks, even if oil prices come down into that $70 to $80, $85 range where they were before the Ukraine invasion. I still think those companies are still going to be cash machines, going to be providing those dividends and the share buybacks. So I still think that's something you watch in those. What else? Would you consider Palantir a buy? I still would have to. I would still have to look at Palantir here. Again. Yesterday before today's sell-off, it was still at about 10.3 times on that price to sales basis, which is very expensive, even for a growth stock. A lot of the growth stocks we've been talking about over this last year, that were trading for 20 and 30 times price to sales last year are now trading for 3 and 4 times on a price to sales basis. Okay, Teladoc is down like to 3 times on that price to sales basis. PayPal. A lot of these other growth stocks that have just as strong growth upside as Palantir are now trading well under that 10 times price to sales. So with today's sell-off, it's probably down to, closer to about 7 or 8 times on a price to sales basis. But that is still fairly expensive. No doubt this company has a great future in data management and data analysis. But, it's just so hard to get excited about a stock trading that expensive, especially when the market mood is so negative on those types of stocks. George says, I have a 30/70 conservative retirement fund, which is down 10%. Any suggestions? Stick with it, George. 30/70, you've probably done very well if it's, so 30% stocks, 70% bonds. I'm assuming that's what you mean by that 30/70 split. It's only down 10%. And the problem with that is bonds have just gotten smashed. Okay, bonds, like we said earlier, the bond market is the worst market this year since 1842. Zachary Taylor was the president back then. There was only 26 states. Okay, if that's any indication how bad bonds have sold off this year, down 18%, long-term bonds down 18% so far this year. You just don't see that in bonds. They're supposed to be the safety plays, right? And that's why your conservative portfolio is down 10%. But stick with it because I think it is a conservative portfolio. It's just that bonds have sucked this year. Okay, we're starting to see that 30-year bull market in bonds wind off. But I actually think bonds aren't a bad investment right now. Okay, and that's even beyond the I bonds that we talked about last week. Great investment there. But even regular corporate bonds. I want to look at the ticker BLV, which is our main bond. The main bond fund that we usually look at, that's the Vanguard long-term bond fund. This is going to be a fund of very high quality bonds from companies. These are all investment grade companies, your highest rated companies. And you look at the sell-off. I mean, this sell-off has just been brutal here. Let's expand this to 5 years so we see really how bad it's been, or the max. Okay, this fund started trading in 2007, and you can see, just the sell-off here since really August of last year, down from $105 a share down to $80 a share. Unheard of, that kind of volatility in bonds. But now, down paying a 2.9% dividend yield. So you are going to get that 2.9% yield. That's a safe yield. These are all very strong bonds, even if the price keeps on coming down. The 10-year treasury, this is what's happening to these. 3.12%. This 10-year treasury rate, all interest rates are going up. That's hurting the value of bonds. But I mean, it's gone up so much. The most analysts, most investment banks think that the 10-year Treasury is going to be about 3%, maybe 3.25%. At the end of the year. So the interest rate expectations, the interest rate has gone up to pretty much to those expectations. So we're basically expecting interest rates to stay pretty modest at this level for the rest of the year. That means bonds shouldn't sell off too much more. But again, even if they do. Even if bonds sell off more, you still get that 2.9% dividend yield. Bonds aren't going to sell off that much more. So maybe you get another 5% downside at the most. And you get that dividend yield, and it's going to protect you from stocks. Okay. That's really what you need here is that protection from that what if scenario in stocks if stocks continue to fall, anymore. So I would stick with that 70-30 split, that conservative retirement fund. Stick with that. Maybe eventually get a little bit more aggressive in the stocks. It just depends on how old you are. Okay, I can't tell you exactly what to do because I don't know how old you are, the rest of your portfolio looks like, things like that. I would be, as a younger investor myself, I would be a little bit more in stocks than a 30-70 split, just because I have more time to see the market go back up. What else? Danny's saying Kathy Wood purchased more Teladoc stocks, Teladoc shares. Again, yeah, Teladoc, one of my largest positions. And again, I know all the haters out there. You look at the stock chart and say Teladoc's done nothing but go down. It's a horrible stock. Well, how do you know? Okay, folks, you cannot just look at a stock chart and know if a stock is a good investment or not. That's the problem. The problem over the last couple of years is new investors have been so spoiled on these stock charts and said, well, you know what? I'm buying what's going up. And it's proven them right. They think they're stock geniuses because they're just buying what's going up, and it's continued to go up. That's not how you invest, though. You have to look at the company itself, at its future. The valuations. A lot of the things we talk about on this channel. You can't just look at a stock chart. That means even stocks that go up, stocks with prices that go up, don't necessarily make them a good investment. Stocks with prices that are going down doesn't necessarily make them a bad investment. You've got to do that analysis. Okay, that's the only confidence, the only assurance that you have that you will be proven right on that analysis eventually on those prices. Okay, what else? How do you review Factset file? Again, you go to Google and let me show you how to find that. So Factset, it's that resource that we used here, showing those sector bottom up target prices and that kind of thing. If you go to Google, so go to Google here, type in Factset. You type in Factset or you type in Factset Earnings Insight. Hit there. Now Factset, if you just do Factset, it's probably the main page is going to be there. So if you do Factset Earnings Insight, it's better. That's going to take you exactly to that PDF file that we talked about. So Factset Earnings Insight, this very first one here, Factset Earnings Insight, it's going to be a PDF. Okay, you click on there, and that's going to find you this whole, this whole report. Again, published updated every week, every 2 weeks when earnings are coming out. It's going to give you an earnings scorecard. It's going to tell you, how the market is doing on a price to earnings basis. It's going to follow a lot of these stocks, a lot of really great charts and analysis here to look at. A lot of the charts that we've looked at here on the channel. So check that out. Surprised travel isn't higher. Nolan is surprised travel isn't higher. I mean, the thing is with a lot of these travel stocks, the hotel stocks, the online booking sites, things like that, they're not necessarily higher, but they're not lower either. Most of those, I mean, with the exception of, I think Expedia did fall last week. A lot of the other ones, Bookings Holdings, I think did very well. Not a booming stock price, but it did outperform the market, and I think that's really what we're talking about here. Is a lot of these travel, hotel, and leisure stocks, are seeing those higher earnings, those higher sales than expected, and so they are, ironically, the safety plays. Usually not the kind of thing you'd think about as safety plays in a stock market crash, but hotel, travel, and leisure are doing very well. So what else? How bad can the error margin be? So this is for Mexico City. Looking for those questions, looking for the question marks. I still like AT&T. Got him pre-spinoff. Yeah, AT&T I think is a much stronger, much better company now that it is a pure play telecom company. It's still got a very good, very strong dividend yield. I think it's over 5% dividend yield still, even after that cut, after the spinoff. And now it is just that boring, stable telecom stock that I think is going to be a cash flow machine. Danny, did you see Doctor Strange? I'm seeing it this week. I heard it's a horror movie with superheroes, so I'm kind of excited to see that. Wasn't a huge Doctor Strange fan from the comics, but I'm gonna be watching for that. But yeah, Disney's got Doctor Strange coming up. They've got Thor: Love and Thunder coming up. They've got a strong lineup for that Disney, for the studios segment. Then they've got the theme parks coming back, in that travel and leisure theme that we've been talking about. They've got that. The only weakness I could see is maybe, their ESPN, maybe their TV segment. But then again, sports should be fairly strong this year as well. So yeah, I really do like Disney. I think they're going to report some pretty good numbers this Wednesday. Even if they don't, it's a good value play right now. What else? Get hit for pushing. God. So some people trying to get political in the chat. We don't do that here. There's another place for that, I'm sure. What else? Troy, JPM, Morgan Stanley. So it looks like JD's asking about bank stocks. I really like the bank stocks. I think it's hard to go wrong in a lot of those larger, big banks. I would stick with the larger ones just to make sure you have that financial flexibility in those. But yeah, JP Morgan, Wells Fargo, even Citigroup. I think Citigroup is one of the best buys right now in banks. Even Goldman Sachs is very much a value play right now. Oh, good news. Thoughts on SoFi? Rich wants to know about SoFi. Ken, SoFi probably along with Teladoc, SoFi, PayPal. I think probably three of my strongest long-term growth stocks. Okay, SoFi. We've talked about SoFi on the channel before. It's one of my larger picks in my own portfolio. And again, it's that theme of future growth and companies that are dominating their industry and changing the way we live in that industry. Okay, SoFi, fintech, online banking, right? Started as a student loan, servicer, student loan refinancer. So obviously that is hurting them right now. The major thing that is hurting SoFi right now is the moratorium on student loan payments. They've still got a lot of their business in student loans, and since nobody's paying their student loans right now, then that's a question mark and uncertainty on the stock. When that gets lifted, even if a lot of student loans are wiped clean, or the what debt is wiped clean, then that's still going to be less uncertainty on this stock, and the stock is going to rise. And that's in short term. That's over the next year. That's going to happen. Over the long term, though, this stock, this is one of the only online stocks, the online fintech stocks, financial technology, online banking stocks that actually has a banking license. Okay, you've got a lot of those other fintech stocks that don't have banking license. They can't offer this kind of rates, the kind of services, checking and saving services that SoFi offers. I think that is a huge competitive advantage for the company, and I think that's really going to help them grow into the future and change that industry. Again, it's an industry. You can't deny that we are handling our money in zeros and ones rather than dollar bills right now. We are just going to continue to do that, work virtually on our finances, and that's going to benefit SoFi. So yeah, SoFi, that's another one of those like Teladoc that, yeah, it's been painful. It's been tough. I just started investing here in this last few months in January. So missed out on some of the fall, but it's still been maybe 20-30% down. But hold on, because I think those are going to do very well. Some of these stocks that I'm seeing, I just don't see. I don't look at very much, so I really can't give you any kind of an idea on them. The market sentiment lowest point and the worst start to the year in years. Do you expect a rebound soon? Again, that's the $1 million question, right? And it would be worth $1 million if you knew exactly what would happen. Obviously, I don't know exactly what's going to happen, folks. Watch any YouTube channel. A lot of these YouTubers, they act like they know what's going to happen, but they don't. Okay, nobody knows exactly what's going to happen. What I can tell you is from my 20 plus years of experience investing, 10 plus years of experience as an analyst, and just watching the markets, the trends that I see, what I'm watching, and what I think is a better probability of happening. Again, we talked about that consumer price index coming out on Wednesday. If that comes in lower as expected, I think you do get a relief rally. I think you get a sigh of relief from investors that maybe inflation is coming down. And, I think at least for the next month, until we get the next CPI number, I think stocks can be sideways or maybe even up a little bit. I don't know that we get a huge relief rally, but I think we do get some kind of a rally, especially after the sentiment and the sell-off that we've seen just in the last month. Okay, just since the beginning of April, stocks are down like 17% in the Nasdaq. That's a sell-off you rarely see that kind of volatility. So I do think there is some potential for an for a rebound, for a relief rally here. Okay, Tim wants to know about life insurance stocks. Yeah, in the finances. Okay, so life insurance, obviously going to be a little bit more safety play. It's going to be better dividend yields. Going to be a little bit safer because that's something you have to buy. People generally don't cut out on their life insurance, even in a recession. So be looking at life insurance stocks just like you do with banks. Okay, what else? Palantir. Yeah, Ron saying that SPAC stocks never should have been listed. It's not that they never should have been listed. They never should have been listed for those prices. I mean, this is something we've talked about over the last couple of years, something I talked about all last year, but and the year before, but nobody wanted to listen because stocks kept on going up. All these stocks that came out with a SPAC, SPAC listing at 20 and 30 times price to sales valuation. Nobody wanted to listen that they were overpriced, but they were. They were, and the bill comes due. The bill always comes due. Okay, what else? Just don't. David brings up a great comment. I just don't have enough cash. Yeah, that's the problem. One is the problem that investors buy on the dip, continuously buying on the dip and push all their cash. They're 100% invested and they can't take advantage of these lower prices. So one is you need that formal strategy. Okay, this is something we've talked about on the channel before. You need a formal strategy to discipline you in how much of your cash you're investing. Okay, so you've got a certain percentage in cash, of your portfolio. You need to say, okay, you know what? I'm not investing any more of this cash until the market reaches this point. Okay, and it doesn't have to be a huge drop off or a huge crash. Just 5 or 10% lower. I'm going to invest a certain percentage of this cash. I'm going to hold the rest. And then if the market reaches this point, I'm going to invest this much cash. Okay. And so you have that formal strategy. So one, you're not just freaking out over the market every single day, wondering if you should invest the rest of that cash. You know when you're going to do it. You know how you're going to do it. You've planned for it. And so you can kind of step back and think clearly, so you need that formal strategy. And it's going to mean you have cash. You constantly have cash to be able to push towards the market if prices keep on coming down, and you can take advantage of those lower prices. But the problem is, again, people freak out about the market every single day. They watch stocks falling lower and lower, and they stress out over, should I buy now? Should I buy now? Should I buy now? And they end up pushing all their cash in way too early because they don't have that formal strategy. Okay, that's one. Two is, this is the best time to start thinking about a passive income, a side hustle, even if it's just over the next 3 months. Even if you have to take figure out a side hustle you can do for 5 or 10 hours a week over the next 3 to 6 months at the most, to make an extra $500 a month to invest. Okay. Again, folks, this is the best time you can invest. I know it might not sound like it. It might not feel like it because you're looking at your portfolio. It's all in red and you're freaking out here. But, when prices are going down, that's the only time you're getting the better deals. Okay. When prices are going up, you never know when the stock market's going to start coming down. You never know when those prices are going to start coming down. Okay. As prices are going down, though, you're getting better deals. Okay. Because those prices will get it back up to those highs. So even if it's just over the next 3 months, 6 months, a summer job. And I hate to say job because a lot of these can be kind of a 5 hour a week kind of work from home, side hustle kind of thing. Find out what you can do to make extra money, because you're going to be happy that you did, when you're investing in these and they go up over the next 10 or 15 years. Okay, Gonzalo wants to know about Biogen. Haven't looked at Biogen a whole lot, but again, those drug stocks, those are typically your safety stocks during a crash. Okay, people have to buy their Mexicin or whatever drugs they're buying to keep them alive. People are going to have to buy those whether the stock market or whether the economy is down or not. So those big, large cap drug stock companies, Biogen, Pfizer, AbbVie, Gilead Sciences, those are going to be relative safety plays. They might still fall a little bit, when the stock market falls. They're going to follow that negative investor sentiment, but they're going to be relatively safer, protect some of your money, and still provide those good dividend yields. So I would be, I would definitely be looking for those. Everything is down. Opinion, earning, Party City. So Nolan says Party City was a reopening stock that has taken a beating. I don't know that Party City was really a reopening stock. I think, Party City saw a lot of that hot stock, that meme stock kind of buying, I think, last year. It was pretty expensive. So, I haven't looked at Party City in quite a while. But I don't know that it would be necessarily a reopening stock. It's also a retail stock, and retail stocks, haven't done well, over the last while. This is the May bottom fishing. HBO Max. Be interesting seeing a video on your top catfish stock. That's funny. That would be a funny stock. So top bottom fishing catfish stock. Again, I don't know that it would be anything, exciting or different, because I think I would probably say the same thing I've said in a lot of those other stocks that I'm buying, that I'm holding, those long-term growth stocks that have come down so much, have come down 60, 70, 80% even, but are still very solid growth companies. Okay. That's something you got to understand, folks, is just because it's not a hot stock anymore, it's not a growth stock, doesn't mean it's not a growth company. Okay. So invest in the company, not the stock. Okay. Warner Brothers Discovery. So Fabricio wants to know about Warner Brothers Discovery, and I'm just going to lump that in with all of the streaming stocks here. I'm still not sold on streaming stocks. I've been saying, over the past year that those costs to produce that content are extremely expensive. So, a lot of what Netflix said in its earnings report, it is very expensive to produce all that content. And with the streaming wars, with Paramount, with Warner Brothers Discovery, with Netflix, with Disney Plus, they have got to produce that content. It's like a content machine that they have to produce. And it's very expensive to do that. So any company without a very strong and established studio, those content producers, the film studio and that kind of thing, is going to struggle. Warner Brothers Discovery, I do like the Discovery side of that because it's a little bit cheaper. That reality TV and history kind of stuff is cheaper. The documentary stuff is cheaper to produce. But then they've got Warner Brothers, that is still also a little bit more expensive to produce. I'm just not sold on some of their streaming stuff, and maybe it's just because I'm biased a little bit more towards Disney Plus again. But yeah, within those streaming stocks, I think I would prefer Disney and its Disney Plus rather than some of these others. Rather than trying to catch the falling knife on some of these others. Do you still believe in PayPal? Yes, PayPal, another one of those that I think is really changing, its industry, changing how we do our lives. A lot of people talking about competition against PayPal and how it's, kind of losing that advantage and that lead and that competitive advantage. And I just don't see it. Yes, PayPal is now reporting 1099 forms for taxes for people that make over like $500-$600 a year. But it's not changing. It's not. I don't think they're seeing a loss in users on that. They did report a slight loss over the last quarter, I think, when they reported, but a lot of that was just wiping off a lot of the fake accounts and the bad accounts that they hadn't wiped off before. So, I mean, I use PayPal for a lot of my invoicing on a lot of my business. I know a lot of people, that work from home and invoice on PayPal. That it hasn't changed anything. The release of these 1099 forms or the regulations behind it. Basically, it's money you made anyway. So you're supposed to report it. You're putting yourself at legal risk if you don't report it. So it really changes nothing. So, I don't know. A lot of people with a lot of these stocks, folks, you see a lot of people say, oh, no, I don't think PayPal's a loser stock or Teladoc's a loser stock because it's gone down 40 or 50 or 60%. How's that analysis? How is that your analysis on this stock? If that is your complete analysis, good luck with that. I'm sure there's lots of channels on YouTube that are just going to, finger porn a chart and say, ooh, this stock is going up, invest in that. This stock is going down, don't invest in that. And that is their complete analysis. But it's going to lose you a lot of money, folks. You've got to do the analysis in these companies. You can't just rely on an eyeball of the chart to pick your stocks for you. But so good luck with that. It is now an hour and 20 minutes into this, and I'm starting to rant a little bit. So I'm going to end this one. Thank you, everybody, again for being here. If I didn't see your question, please ask it in the comments below. I've got a big lift day in the gym today, so I'll have plenty of time to answer comments and look at that while I'm at the gym. Thank you again, though, for being here, and I will see you in the next video.